Good morning and welcome to the i3 webinar co-hosted with Aberdeen, where we'll focus on climate scenario analysis for equities. I'm Tech Tan with i3, and I'm pleased to have Camille Simeon join us today. Camille is an investment director in the Australian Equities team at Aberdeen, with portfolio management responsibilities for the Australian equities funds. And as a stock analyst, she covers the mining, energy, and technology sectors. Camille is also the global equities representative on the steering group for the Aberdeen Climate Scenarios Analysis Tool, something we'll cover a bit more in a moment. So let me just set the context for today's discussion. Now, the physical manifestations of climate change and destructive outcomes, while not totally clear, are broadly accepted. We've just had COP26 in Glasgow, where we've witnessed an array of policy initiatives, private sector commitments, technology announcements, all aiming to constrain greenhouse gas emissions. And as we've also seen, the politics of climate mitigation varies considerably across the major economies, and the abatement opportunities also vary significantly across sectors. As such, the transition is likely to proceed at different rates. So the issue we're trying to address here is, how do you then assess the impact of this energy transition and climate risk on asset prices, bearing in mind the unevenness of the transition caused by the multitude of variables. And to this effect, we'll attempt to employ the use of a scenario analysis framework that Aberdeen has developed. So with that background, we'll address today's session in sort of three broad headers. Firstly, we'll propose a framework for climate scenario analysis, looking at some of the assumptions and the building blocks that underpin the model. Secondly, we'll discuss the findings. We will here, in this case, focus on Camille's area of expertise, so that's Australian equities, as well as the sectors that she covers, energy, utilities, and materials. And last but not least, but certainly most important, is the application to company analysis and the engagement process. So in terms of format, this will be a fireside chat with Camille for a total of about 40 minutes. Given the somewhat nature, the technical nature of the content, we'll use a couple of slides as and when necessary to help illustrate some of the points during our conversation. So I encourage you, the audience, to submit questions via the question box, and we'll endeavor to answer them in the course of the conversation. This webinar is for educational purposes only. It does not constitute financial advice. It is intended for wholesale and institutional investors only. To kick off, Camille, welcome. Let's start by jumping into the climate scenario analysis model that Aberdeen has developed, and perhaps you could help us understand the inputs and the building blocks that underpin the model that Aberdeen has developed. Camille?
Well, thank you, Tech, and thanks for having me today to talk about this really important topic for us, as a global citizen, but also as investors, where we do have this really important role in capital allocation and deploying capital to decarbonise in the real world. You've certainly highlighted the why of climate scenario analysis in your opening remarks there, why we do this, because there is a vast amount of capital and resourcing going in to try to solve this collective action problem. We certainly saw enhanced ambition at COP26, but as you pointed out, there's still very much a lot of uncertainty in terms of the pathway that we progress on. So 1.5 degrees is still alive, just alive. But in terms of the best outcomes we could expect at this stage from all the ambitions and policies and commitments that have been announced, it's a 1.8 degree world. But in reality, based on nationally determined contributions, we're on a 2.4 degree pathway. So on the one side, we've got this uncertainty around the technology pathways, the temperature pathways, the policy pathways. But on the other side, it's very clear that we are decarbonising. The global economy is decarbonising. This is a mega structural change that is going to go on for many decades. So for us as investment managers, we need to be able to assess the climate risk and opportunity in our investments. We need to integrate that into our research process to identify climate winners and losers, to be able to generate decarbonisation alpha and to build resilient portfolios to climate risk and opportunity, and enable our clients to reach their net zero goals. And so climate scenario analysis is really the tool that enables us to do that. And that is because it identifies the future impact of climate scenario pathways on an asset's valuation compared to what the market was pricing in. So what it effectively provides for us is an impairment or uplift on an asset's valuation when we're thinking about different climate scenario pathways. So that's really the why of climate scenario analysis. You know, at the core of it, it's about integrating climate risk and opportunity and identifying winners and losers. So in terms of the building blocks, and I do have a slide here actually, Sophie, if you wouldn't mind just popping that up on the screen, thanks. So this is the building blocks to climate scenario analysis. So taking it from a high level, what we firstly do is we create scenarios. We then translate these into economic shocks that ultimately impact at the corporate level to generate the valuation impact. So that's the high level of the building blocks. But when we dig a bit deeper, when we think about scenarios and the creation of our scenarios, you know, climate change risk is transitional and it's physical. So the transitional risk, we've created pathways around. So we've thought about the energy system and how that might evolve. We've thought about technology, who will be the winners and losers there, and policy, how policy will change as we transition. And then the physical is really about emission changes. So they're also, you know, they're still rising. We did see in 2020, certainly emissions fell by around about 6%, but they are rising again, and it looks like we'll be back to pre-COVID levels by the end of this year. Temperature changes and the impact that has on the physical environment. So what we have done and what we do is we translate those macro assumptions into the micro level. So economic shocks, which can be both direct and indirect. So direct shocks are, how does a carbon price impact a company? How do cyclones impact physical assets? And the indirect are like demand pattern changes or price changes, cost curve changes. So once we've created the scenarios, we've then translated them into economic shocks at the corporate level. We then model these against a company's asset value stream and ultimately generate that forward impact compared to what the market was pricing in against these climate scenario pathways. So they're really the building blocks. I guess one other point I'd like to make here is just depth of modelling is important, because you will also need to think about where a company sits on its cost curve, what the industry structure and dynamics are, because there will be abatement and adaptation measures available depending on the cost curve and the position of the company on the cost curve. So we do account for those in our modelling as well, which has really important implications for investment risk and opportunity, the insights and the data that we really get from the tool.
Yeah, I think, Camille, obviously, to our audience, I know this is a very crowded slide. We probably can apologize for that, because I think this is as simple as it gets, because at the end of the day, I think you want to capture as many dimensions. As you mentioned, there are policies, there's geographies, there's abatement opportunities, there are energy systems, and I guess, again, my understanding from the use of a scenario analysis, not just climate, but for just general business scenarios, you're trying to capture as many variables, not trying to, I guess, predict what will happen, but saying these are the various possibilities. And I thought this is a good comprehensive starting point on which you then build. I guess, as we discussed, governments, we have heard so many pledges, and I think one of the common things I hear is, yes, COP26 will be successful only if the pledges are carried on, forward. Is it or is it not? I guess it's a question, and hopefully it is. But there are various governments and various objectives as well. So it's the difficulty in modeling that sort of uncertainty as well that I guess you're trying to capture here. That's
exactly right, Tech. So, we're dealing with, so much uncertainty around technology that hasn't even been developed yet, not yet scalable commercial, how governments are responding, and that's changing at a very rapid and dynamic pace, which is great. That's what we want. We want to see progress. But yes, and we're also dealing with, many decades of this transition. So we need to be able to put that in, translate that into investment risk and opportunity, so we can understand the risk at the stock level or the portfolio level. And certainly scenario analysis is the tool. It is very complex, but hopefully I've been able to break it down here to make it a little bit more digestible into how we think about, building scenarios and then translating them into the corporate level and against a company's asset value stream to generate, where the investment risk, who are the climate winners and who are the losers. So that's certainly what this slide tries to bring to life.
Yeah, and I think, Camille, before I ask you to go into, extrapolating this into, the various scenarios, I know there are a couple of technical terms. We're not going to go too much into it, but issues like, energy systems, where I know you've got the, what they call, under your transition pathway, you've got remine and meshes globium. Really, these are technical terms. I'm not going to spend too much time on it, but I guess it really speaks to where you see the energy systems will be. There's been discussions about, is gas a transition fuel? Is carbon capture storage going to be possible or expensive? I think these are possibilities as well. We don't really have the answers, but I think it's about incorporating those uncertainties into the overall thinking, the overall framework.
That's correct. So on the slide here, we do have energy system integrated assessment models termed Remind and Message Globium. And really that's thinking about how the energy system will evolve out to 2050. And so is gas a transition fuel? And so CCS has a role there. And so what is the size and shape of gas in the evolution of the energy system? And then when we think about solar and wind and the scaling up and the commercializing of that, and certainly we've seen that come through in leaps and bounds in the last 12 months. So that speaks to the energy system and the evolution and the pathways, because it's still, it's not clear exactly what the market share of gas will be in the energy system. So we do need to make and create assumptions around what the energy system looks like or could look like. And then we obviously translate that to company risk, and that is obviously has different impacts for different companies depending on their exposure there. But it's probably worth jumping into the scenarios as well, Sophie. So thanks for that slide. I do have another slide, if you could please bring that one up. And these are the scenarios. So when we we've created scenarios, these are the scenarios that we use and that we have developed as well. Internally, we do work with a provider, Planetrix, who's part of the McKinsey group on our climate tool modelling. So really one of the key differentiating aspects of our work, which really has impacts or important implications for investment risk and opportunity, or the insights coming from the tool, is the scenarios themselves. So what we find is that off-the-shelf scenarios make assumptions around uniformity of transition pathways. And in reality, that's just not how it's playing out in the real world. That certainly came through at COP26 when you saw India set a net zero target of 2070, which is really realistic given the nature, the stage of their economic development. Really, we should be seeing developing markets push harder and more aggressively to reach net zero ahead of 2050, so that emerging markets have a chance of hitting that a couple of decades later. But that's not coming through in the off-the-shelf modelling, as you can see here on this slide. Down the bottom half of the slide, the off-the-shelf scenarios. And we are actually doing some year 2 work now, and we're moving to the network for greening of the financial system scenarios, where it is similar, uniformity in how transition countries, geographies and sectors transition. So EU transitioning at the same rate of EM is not how it's playing out and not how we expect to evolve. And then also the power sector, transitioning ahead of industry is a more plausible assumption. So we have created our own bespoke scenarios which allow for or relax that uniformity of transition and allow for countries and regions and sectors to transition at different rates. And that's important. That has important implications for the output coming from the tool in terms of how that relates to climate winners and climate losers. Another important aspect of our work is that we have created a mean scenario, just going back to our conversation, where we don't know exactly the pathway we're transitioning on. We can make assumptions around energy systems and technologies, but it's still not entirely clear what it will look like in 2050. So we have weighted different scenarios based on our view on plausibility and created a mean scenario. Now, we do cover a lot of scenarios here. We do have 16 scenarios, so there's 15 on the page here. There is another scenario which is where we have weighted scenarios that have Paris outcomes. We term this our Paris weighted scenario. And essentially, you know, we are covering a broad suite of temperature pathways, and within that, obviously, those assumptions around technology, energy systems, and policy. And that's because we don't just want to examine tail risk. So we don't just want to examine Paris, because yes, that's the future we want to live in, but reality, that's not the world we're heading to. And we don't just want to examine or analyse a hothouse world of, say, a 3-degree warming. We want to examine that vast probability in mass of distribution in between those scenarios, because that is the true nature of climate risk and opportunity, and in reality is the pathways that we're heading down. So we do examine a broad suite, but that's important because you don't just want to examine tail risk, you want to examine the true nature of climate change, which is those scenarios with temperature outcomes in between of the extremes.
Yeah, I think that's a really good point, because I've seen other models out there that I guess are overly simplistic. They talk about, you know, Paris orderly transition, or delayed, you know, Paris disorderly transition, or failed transition. Now, these are, as you pointed out, sort of tail risk type events, but there's a whole spectrum in the middle of different variables that I guess are more meaningful, because we're talking about the impact on stock prices as well at the end of the day. That's why we're going through this exercise. Camille, again, I know this is a very busy slide, and I'm going to try to unpack some of these. So you've got, I guess, 7 off-the-shelf one, and these, as you mentioned, extracted from your partner, Planetics. You've also developed 7 bespoke based on that. And then you have a probability weighted scenario, and another probability weighted, but that's Paris aligned, so that makes it 16. When I look at the various inputs here, again, just to help our audience, so I can see that you've got different geographies. Again, that's, you know, you can get really granular, but I think for now it's the US, it's the EU, it's China, rest of developed, and rest of developing. And I can also see the sectors. It looks more like the brown industries they were familiar with, and industry, building, transportation, power. Is that sort of how you look at it in terms of the different inputs into the framework?
Yeah, that's correct. So our modelling is at a sector and a region level, and then, but we do look at, you know, the company's asset value stream. So it's at this level where we dig into, you know, a company's business units, its profitability, and then that's where we make, you know, modelling changes, accounting for industry structure, competitive positioning, and so adaptation measures, depending on where they sit on the cost curve, what their emissions profile looks like. And so that's really the depth of the modelling that's important in terms of translating that into investment risk and opportunity, or where the climate winners and losers are. So it's the depth of modelling at the company level, which is really important for the output.
Yeah, and maybe I could ask you again, what's interesting is there's a framework, you've got the inputs, obviously things change, whether policies or systems, and things change. I guess what our audience will probably more interested is the application of, and I think when I been through your research, one of the things that stood out was in terms of the findings, there was that dispersion at the company level, and that's where it's the most disaggregated level, and that's where it's interesting in terms of the risk and the opportunities. I was wondering if you could, you know, talk a bit more about how this translates to findings and dispersion that you've observed at that level.
Yeah, absolutely. So if we now pull up the next slide, Sophie, I think this is the last slide that I've brought, on dispersion. So really the key takeaway from all of our climate scenario analysis and the data coming from the tool is that climate change is really risk and opportunity at the stock level. It's a micro phenomenon. So when you aggregate results at the sector or index level, there is a masking of the dispersion of outcomes at the stock level. And this is really the opportunity to generate alpha for active stock pickers, to be able to identify winners and losers and then make investment and portfolio decisions around that. So what this slide here shows you is the ASX 200, and there is a crowding around, 0% in terms of the impact. But what you can see here under our mean scenario is the dots are stocks and the colours are sectors, and that is the dispersion of risk at the sector level. So you can see here in the utilities sector that there's a very, very wide dispersion of risk here. There's a climate winner, but there's climate losers, and you can see that across. That's really clear and evident across actually all geographies globally. That the greatest impacts from climate change risk from climate change are really in the utilities, materials, industrials, energy sectors. You will get some risk in, there will obviously be outcomes or in other sectors, but that's where the majority of the risk and opportunity sits. And so if you were just analysing it at a sector or an index level, you would miss this opportunity to capture decarbonisation alpha by digging deeper into where exactly the climate risk and opportunity sits within the investment universe and within your portfolios, and that really comes to light here in this slide here. And it really was one of the key takeaways from all of our work, and it continues to be the key takeaway. We are updating our analysis, and we continue to do that, and that's really a key feature of our work, is that because we do have our own bespoke scenarios, we can update it as new information comes to light. We're going through that process right now, but that also, as an analyst, I can assess, when new policies come through, I can assess what does this mean, which scenario should I be looking at, where should I be looking for the dispersion of risk and opportunity.
I think, Camille, again, this chart is interesting because, other than the industries that you mentioned and I guess coincidentally industries that you cover, the rest are very much in the middle. I was wondering whether you could elaborate by giving maybe examples of, whether it's the energy sector, materials, why there's that dispersion at the company level, why there's so much difference in companies?
Yeah, so it will also depend on the scenario that you're looking at as well. So, it's actually interesting because in the energy sector, in Australia, there are clear climate losers when we look across our suite of scenarios. But if you were to look at a hothouse world, then they do get they are a beneficiary or a climate winner. But obviously the reality of that is that it's not the world we want to live in, not the world that, the direction of travel in terms of policy ambition and action is going. So energy is certainly a sector where there is material risk across all realistic and plausible scenarios. And that's the same, there's nuances in the utilities sector depending on where, whether you're a fossil fuel generator or you're a renewables generator. So we need to assess, the scenarios, the plausibility of the scenarios, and then what this means at the sector and stock level, and be able to, make investment decisions around that.
I guess, again, staying on the energy, utilities and resources sector, because again, that's where the most dispersion is most interesting and no surprise, again, that's impacted. Early on in the piece, we talked about energy systems, and again, this is the debate of whether gas is a transition fuel, whether CCS works or not works, and so on. I guess what some would define as technology pathways. I guess this way is crucial, particularly in the energy sector as well.
Correct, yeah. So, the assumption has been that gas is a transition fuel, but our work shows that that's far from certain. And, the scaling up and, of renewables, solar and wind globally is having, implications for that view that gas is a transition fuel. So as an energy analyst, I need to think about that within my stock coverage universe. And think and have a look at what companies are doing if they are highly exposed to that gas as a transition fuel. So, there's certainly technology developments underway there is CCS to, you know, abate carbon, but you know, there's technology risk around that, and there's technology risk around that from a CCS point of view. You know, we would ask companies to get independent verification of their projects, given that is in some cases a material immateriality in terms of their roadmap to being, you know, reducing their carbon emissions. But then you also need to think about technology risk more broadly. So we would encourage boards, for example, to broaden out their skill set. So, you know, technology is evolving rapidly. The pathway to net zero is going to be, you know, we're going to evolve along that with technology that is not yet commercial scalable, or technology that's not even developed. So for companies that do have, for example, gas as the transition fuel, we do encourage them to think about technology in their own universe, but also technology more broadly, because that is a risk and an opportunity for them as well. And so that comes through in our scenarios, because we do have, you know, different scaling of technologies, and that has implications for the scenarios, and then obviously the impact on at the asset level or the equity level.
Sure. Camille, I have a question from the audience, and we've talked about risk, and we've covered transition risk quite a bit. There's another dimension of risk, that's physical risk. And the question relates to, you know, physical risk. So how is physical risk, you know, exposure to, whether it's hazards, cost, you know, hits productivity and the like, how is that being built into, again, the scenarios and the models that you use?
Yeah, so in our assumptions, so when we've created scenarios, if we go back to that building block slide, thanks Sophie, that would be quite helpful actually, the first slide that you brought up. So if we go back to this slide and the physical pathways, so we've developed scenarios with assumptions around emission levels, temperature changes, the variation in climate, and how that impacts at the physical level. And there's actually been modelling done on, for example, synthetic cyclones and the impact that would have on the physical landscape, and then how that impacts at the asset level depending on the location of assets. So obviously if you're in the tropics, then there'll be likely more of an impact. So we do account for physical pathways in our scenarios, and we see that in the impact channel, and we're actually doing more work around this in our subsequent program of works, because we are finding that there, you know, you just have to look in the outside world and the amount of weather events that we are having and the effect that is having on the physical landscape. So we are doing a lot more work around that and building models where we are raising the physical risk, so we can think about that at more of the extremities, given the events that we are seeing play out in the real world.
Thank you. And a question here on, might be get technical. I'm not sure whether that's within your scope of coverage, but we'll have a go. If not, we might push this all to Jeremy Lawson, who's the chief economist, who's the author of the report. Again, when we talk about emissions, there's scope 1 and 2, which again fairly straightforward. Scope 3 is where it obviously gets a bit contentious at times, and the question relates to scope 3. So to what extent are scope 3 emissions factored into the modeling?
Yes. So scope 3 emissions are harder to deal with. That's just the reality of not just what we are having to work at with as investment managers, but even corporates themselves having to build that. So we don't have scope 3 in there at this point, because there just isn't the data around that. But the point to make here is that, so with this scenario analysis and the insights that we get from the tool, we don't just apply these mechanistically. So we don't just take this data and that informs our investment decisions and portfolio construction decisions. That's not how we use the data. We use the data as insights to inform our investment research and engagement programs. So we want to assess, we take the data and the risk or the opportunity. In my case, it's a lot of risk because I'm covering mining and energy. So I'm taking climate risk, and then that's integrated into my investment research program as I'm assessing the climate change readiness of management and strategy. Because in reality, some companies will be better at exploiting opportunities, and some companies will be, not as good as mitigating the risk. So I think about the scope 3 in that context. Although it's hard to get the data at this point in time, we are working on that. But as an analyst, I can look at the emissions profiles of companies, look at their ambitions, their roadmaps, and that's how I would assess. That's how I assess scope 3 in that manner.
Yeah, I guess the difficulty again, you're trying to be forward-looking because again, most models are backward-looking with data, and we've got lots of history. But it's that forward-looking because you're looking at future company targets, plans, strategies, and making a judgment on those as well. Yeah,
that's right. So we get, the data we get from the tool is really insightful in terms of the size and the shape of the risk under plausible climate scenario pathways, but it's really important to overlay that with the climate strategy of corporates. So ultimately, as investors, we want to be allocating capital to those transition leaders, those companies that can affect change in the real world. There's a substantial amount of capital that's ready to be deployed into these leaders, and we are certainly taking portfolio construction decisions using the insights from the tool, assessing climate change plans and strategy of management teams, and that will really depend on also the level that the company is at. So some companies are producing their own climate scenario analysis, and we certainly recommend them to do that because it's difficult to be allocating long duration capital if you don't have an understanding of the climate risk or opportunity within your portfolio. You really need to know where the risk sits and then be allocating capital to mitigate that risk. And so the conversations we are having with companies that do their own climate scenario analysis are different to those who don't. So those companies that do their own climate scenario analysis, we're comparing and contrasting scenarios. It's probably very unlikely that we're going to have exactly the same scenarios and insights, but that is our job as analysts to compare and contrast, to assess the validity, the credibility of their strategy that backs up their ambition, because it's all good to have ambition, but we don't want a credibility gap in terms of the roadmap to be able to achieve those goals. And then the conversations we're having with companies that don't do their own climate scenario analysis is a different level. It's how do you assess your own climate risk and opportunity? What are your plans to be able to more robustly fit that into your strategy? What is the governance and oversight? And that's across all companies, really. Governance and oversight, accountability, responsibility, it's all very important because ultimately, we're setting long-term goals, and so it's important to have the interim goals and then accountability to support those interim goals so that management teams are incentivized or penalized if they don't reach them. Because it has important implications for investors. We want companies to be aligning themselves with their value chain, which is very clearly decarbonising. We're seeing very broad commitments being made globally, and so they're the types of conversations we're having. And then just going back again to how we think about companies that are doing their own climate scenario analysis. One of the features, again, adaptability is a feature of our work, but another feature of our work is that we can assess companies cherry picking their own climate scenarios to fit with their capital allocation strategy, because that is not an outcome that is probably the right way to allocate capital, long duration capital, if you're cherry picking scenarios to suit your own capital allocation strategy, if you're not alive to all the risks and opportunities within your landscape.
Yeah, I think the thought of cherry picking crossed my mind. I was going to ask you that, because as you compare and contrast, surely there must be differences, whether differences in the process or the outcomes or the assumptions that underpin the model. I'm wondering, again, there might be compliance issues, but to what extent could you give some examples of your interactions with company? And this is really about applying your model to your company analysis and how that plays out, you know.
Yeah, sure. So we have had a utility company actually within our portfolios where we did identify this material climate risk from the climate tool. And so that was then integrated into our investment research program where we did a deep dive into climate strategy, capital allocation strategy, assessed their climate scenarios and understood that there was cherry picking of their scenarios to fit their capital allocation framework. When we engaged with them, because we are active owners, engagement is very important to be able to, really assess the climate winners and losers using the data from our tool. When we engaged with them, there was no willingness to be alive to the risks that we saw, the very material risks. And so we took an investment decision and a portfolio decision to exit that name from our portfolios. And what we've subsequently seen in the quality of the revenue stream is that that risk is starting to come through that we had identified. But we've actually, as a house, created new commitments just earlier at COP, where we're going to reduce the intensity of our portfolios by 50% by 2030. And active ownership is very important underpinning that. So we will engage, we want to invest in decarbonisation leaders. That means investing in companies that are high emitters, but are transitioning to a low carbon world, because that's where the solutions are going to come from and where you are going to get real and meaningful decarbonisation. So we have created, we've developed the new goal where we will engage, and if after 2 years we haven't seen progress, then we will exit if we don't see that progress as we work towards Paris goals. So active ownership has always been very important to us, but we're now really putting these targets and timeframes around, climate strategy, climate ambition, and credible roadmaps as we progress. Yeah.
We've just got a couple of minutes left, and I think in any climate change discussion, you can't not talk about COP, given that it's just been over, and as I mentioned, it's been various pledges, announcements. I guess at a high level, there's some progress, although we're not getting to debate whether it was a success or not. But I guess my question relates to with the recent conclusion of COP26. How does that then impact your model? Because I presume your model was done before COP was staged last month. So given the different pledges, announcements, how does that again impact the model that you have?
Yeah, correct. We have made changes. So we are going through our year 2 work program as we speak, and we did see good progress from COP26. It's not enough though. So as I mentioned earlier, 1.5 degrees is alive. The Glasgow Climate Pact requesting companies to come back next year and ratchet up their ambition and actions to support that. You've got, one of the standouts really was the finance sector really leading the charge, ready with a substantial amount of capital to deploy into decarbonisation. But the point of all this is that we make changes based on credible policy and actions that back that up. Sure. So we want climate action and credible action. And so what we have found is that we have seen a tightening of policy, an enhancing of ambition, but yet the pledges, the binding commitments to back that up there is still a credibility gap there, but we are changing the scenarios of our mean scenario, changing the probabilities, I should say, of our mean scenarios, given what we have seen, particularly through COP26 and also in the last year. And so the temperature outcome for our mean scenario has tightened from a 2.4 degree outcome to 2.2 degree outcome. So it is better, but it is certainly not where we want it to be. We really need to get it below 2 degrees.
At least there's a little progress, albeit a lot more that could be done. And I think, again, back to the beauty of a model like that is by assigning probabilities that do change. Again, like you said, depending on how serious you think the pledge should be carried out. Hopefully that helps you the dynamic process as well.
Yeah, that's correct, and that's exactly right. So the fact that we do have bespoke scenarios, that we do have this mean scenario where we are probability weighting plausible climate outcomes, we can tweak our and make changes, and that has really important implications for identifying climate winners and losers, and for building climate resilient portfolios and developing these net zero solutions for our customers. So that feature is really important in terms of integrating climate risk and opportunity into our investment process.
Yeah, I think look, that's all the time we have. Thank you very much, Camille and team at Aberdeen. This subject obviously has been, it's fairly complicated. I mean, it's complex because of the different inputs to the model. And I think as we discussed, we want as many variables. We want it to be as granular as possible. There's only so much you can do to keep it simple enough to understand, but yet and incorporate as many of these variables, whether it's policy, energy systems, geographies, the politics of things, risk dimensions, sectors, subsectors. To our audience, there is a 60-page research document that we will certainly make available. I will recommend you to read. So to our audience, I hope this has been educational and relevant. This has been a fascinating discussion as we attempt to build this framework. Now, we've only focused for today's discussion on Aussie equities. There's probably scope for broader discussion because this certainly can be applied to other parts of the portfolio, credit, real assets, and others, which could be a subject of a different discussion. So for now, I hope this has been meaningful. Thanks again, Camille. For now, stay well, be safe, and hopefully see all of you very soon. Bye for now.
Thank you.